Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
You know, AAA, I've been thinking about it, and this current investing landscape, this current stock market situation reminds me a lot of Phil Fisher and his quote, "The stock market is filled with investors who know the price of everything, but the value of nothing." And as we change this paradigm in interest rates, it's really difficult to understand the value of the stock market, of the S&P, of the stocks everyone's talking about right now.
Right. Right. Yeah, that's a very good point. You know, there's a paradigm shift going on with interest rates, like you said, and people aren't shifting as quickly as they should be, especially when it comes to, that dream retirement takes a new paradigm. So stay tuned for today's show, Dream Retirement, a New Paradigm. Andrew Agemy here.
And I'm Daniel Agemy. And today we are going to be talking about this dream retirement and this new paradigm that we see going on, both in people's retirements, but also in the investing landscape. AAA, you've been helping people retire for a long time. We speak a lot about you need to do something a few times before you are considered, good at it, an expert at it, even skilled at it. And if you've retired a couple of times, unless you're, a serial entrepreneur or something, and you're going back to work because you build another business and then you retire and then you get bored. But if you had to, you retired in, let's say, 2006, and then you lost your money in 2008, and then you retired again, you've learned a lot, but that's not really the best way to learn how to retire, right? No. It's better to learn from other people how to retire and stay retired. So you've been doing this for a long time and you've helped a lot of people retire. You have not retired yet, but you've vicariously learned or lived through all these people you've helped. Yeah. What are you seeing in this new landscape, this new interest rate paradigm?
Well, that's a great question, Daniel. What I would like to say is, you just said I haven't retired, but I could retire tomorrow. And before people think I'm braggadocious and prideful, why I say that is because the principles you hear on financial strategy is that Andrew and Daniel Agemy and that we teach in our firm and that we exercise in our firm for our clients work. They work for me, they work for our clients, but I choose not to retire just yet because I'm on a mission. I'm trying to help others to do it. I mean, if I weren't doing it, who would do it? I mean, you could do it, Daniel, but, two are better than one, right? Yeah. So, we are able to hit and reach more people together than individually or if I weren't even here doing this, right? And, besides that, I have too much energy. I'd be bored. So I need to do something. Retirement is a new paradigm for people themselves. A paradigm is a different way of looking at things. And the way that I describe that new paradigm of retirement is kind of like a mountain that people are climbing up their whole life, that mountain of retirement. You get near the top and, it's a snow-capped covered mountain. You look over the side and it's scary. It's scary for a reason because, change is happening, right? Three things in life are certain: death, taxes, and change. And the thing about change is not that change is bad. It's how you respond to change that can be bad or good. And what you do with change that's going to bring about the opportunity or the opposition. However, your response is going to dictate that. But the point is, it's scary, this new paradigm, looking at things from a different perspective, from this high top, snow-capped covered mountain. Your paycheck is changing, your friends are changing, your schedule is changing, your lifestyle is changing typically. And because of that, it takes serious consideration. I've heard it said that, and I believe it, is that retirement is like a week full of Saturdays. And what do you do on Saturday? You spend a lot of money. And so you have a week every day you're doing that because you're retired. Well, you're going to need to make sure that you have the money that you need to do that. And when you're talking about interest rates, that is a way that, today's retiree is different. It's a new paradigm for today's retiree than it was for the retiree in 2017. It's a whole different thing, or 2006, like you mentioned, right? Interest rates are at highs that we haven't seen for 10, 15 years. And that makes, the aspect of investing in the stock market questionable. because who wants to put their money at risk just to have it at risk? Usually why people have their money at risk is to be able to get more return on their money. And when you're getting, 5, 6, 7% interest rates on CDs and bonds and fixed interest kinds of things, I mean, why would somebody invest in the stock market making 6, 7, 8% on average, or maybe 9 or something, especially at a time when, we don't see anything happening? It's kind of crazy, right? So
Yeah.
I'm rather long-winded there, Daniel, but let me just, if you're just joining us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Dream Retirement, a New Paradigm. Glad that you're with us, because people don't know what people don't know, and you're going to learn things today that you don't know. Stay tuned for that. In the meantime, we've got something that we want to give to you to be able to help you learn even more. How much do I need for retirement? How much do I need to retire on? And a lot of people have that question. When can I retire? How much do I need? And we have a paper. It's only a couple pages long. Glad to put it in your hand to be able to educate you and help you get those those gears turning in your head for retirement, because it's a new paradigm and you need to learn things for retirement. Now, you can take the time to learn it yourself, everything, but you never do that, right? Compared to somebody that's been doing it for decades, there's a lot of time where you can learn from others when doing it for decades. So call us for your free copy, 800-725-7616, 800-725-7616. How much do I need for retirement? Ask for the paper. Operators are standing by now. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic, again, as I said, is Dream Retirement, a New Paradigm. Daniel, this whole idea about paradigm, is huge, right? How people look at things. And people don't know what they don't know about retirement. They don't understand. So many times when I meet people, they don't get what retirement is about and how their investments need to be different than they were when they were growing the money, when they were working.
Yeah. And risk-adjusted return, when we're talking about retirement, when we're talking investments, I think this may be one of the most misunderstood, not talked about investment philosophies that people really need to understand. And when we're talking about a paradigm shift, what we're talking about is, we've heard, how long have we heard it? Don't fight the Fed, don't fight the Fed, don't fight the Fed. And usually that's in reference to the Fed saying, hey, we're going to keep rates low, we're going to lower rates, we're going to do this, we're going to be accommodative to markets. And so people are saying, well, you got to be in markets. If the risk-free rate, risk-adjusted return is typically calculated using the Sharpe ratio. There's other things that you can use to calculate it. But basically what it does is you have a hurdle. And the hurdle is what's considered the risk-free rate. And that would be a 10-year Treasury bond, a 10-year U.S. Treasury bond, because the U.S. is one of the highest rated credits. They have a money printer. They can always return your money. So this is considered the ultimate safe asset, the 10-year U.S. Treasury bond. So if that's at 0, you basically can do any investment you want. As long as you earn 1%, you've beat the risk-free rate, right? So you can leverage up. You can start businesses that may or may not be a good profit margin, may not be a good idea. But all you have to do is earn 1-2% and you beat the risk-free rate. Well,
making your risk worth the reward in that example.
Exactly.
That's always the question. Is the risk worth the reward?
Exactly. So as we've raised rates, as the Federal Reserve has raised rates, it's up to about 5.5 or so on the short end. And here's another strange thing. The interest rate curve is backwards. If you go into a bank and you say, here's my money, I'd like to earn some interest. Right. Would you expect, listening audience, that if you gave the bank your money for 10 years, you would earn more or less than if you gave the bank your money for 10 months? Well, there's more risk in 10 years, so you would hope you would earn more for the 10 years, you get locking your money up for 10 years. But it's backwards now. You earn more for the 10 months than the 10 years.
Crazy.
It's crazy. It's crazy. But that's what's happening. So on the short end of the curve, you could earn about 5.5, and the 10-year, it's about 4.25. So if we use the 10-year, you have a hurdle rate now of about 4.2, somewhere right in there, right?
Right.
So it's not so easy when you're talking about buying the market, or you're talking about starting a business, or you're talking about taking a loan out to, do property, plants, equipment, expand your business, any of these things, because your hurdle rate is much higher than it's been in a long time. And the paradigm shift is people haven't caught up yet. The Fed keeps saying higher for longer, higher for longer. Do we think they're going to keep these rates high for 10 years? We don't think so, but there's still this paradigm shift where you can take advantage of these things. And the paradigm shift is saying, why would I take risk where I could have a 50% drawdown and who knows how long it will take to come back? Or I could have 10 years of earning nothing when I could do something like earn 5% in a treasury, or I could, get a spread on the 10-year and maybe get 7% in corporate credit, or corporate bonds, or something that pays me where I can just sit back and collect my interest.
Yeah, that'd be sweet. Yeah, that's beautiful. So we got two paradigms shifts going on, right? One is for retirement in general, because it's a different way of thinking and looking at that kind of thing. Then the second is the paradigm shift of investing today. And, where everybody, especially baby boomers, enamored with the stock market because, all their working career, the stock market's basically been going up for the most part, or at least they feel that way. And, but now the market is not going up and interest rates are up. They're back to where they were, when they started in, their careers, because interest rates are about this high back then. And it's just a crazy thing. So new paradigm. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Dream Retirement, a new paradigm. And we want to talk to you more about that. In a few minutes, we're going to have to take a break. But before we go to break, we want to give you this book, The Most Important Thing by Howard Marks. And it's an easy read book, short book that will give you some good perspective on how to change your paradigm as you change into retirement and looking at retirement, pre-retirement. If you're within 10 years of retirement or in retirement, you need to read this book. It will help you to be able to understand how you can retire and stay retired. At Agemy Financial Strategies, we believe that an educated retiree is a happy and stress-free retiree. Same thing with Financial Strategies with Andrew and Daniel Agemy. We believe that educated retiree is a happy and stress-free retiree. We want to educate you with either the papers that we gave away earlier or the book. Call now, 800-725-7616. Operators are standing by, 800-725-7616 for your free copy. To the next 5 callers. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
You're playing in a basketball game. You're the coach. You're up 25 points. It's 2 minutes left in the entire game. There you are. You have some decisions to make. What do? Well, most coaches would pull out the first string, put in the second string, and go to just running out the clock and keeping their lead, as opposed to risking the season, maybe getting a key player injured or losing the ball, losing the lead in that last 2 minutes. Which do you do? I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about dream retirement, a paradigm shift. And AAA, what's basketball have to do with dream retirements?
Well,
I don't know if a lot of our listeners are going to be wanting to be going play. I'm sure there's a couple, but to be going and play in basketball, what are you, or coach in basketball? I don't know, but what's that have to do with retirement?
Well, people are the coaches of their portfolios, of their retirement returns. How many advisors does it take to ruin a portfolio? One. And, that's where people recognize that they're the CEOs of their money. They're the ones that have to be in charge. They're the coaches. They're the ones that need to make the ultimate decisions, but, that's where the idea comes into play. When you're looking at your investments, do you go for broke? Do you risk the money in the stock market the way that you always have and risk being like the people who wanted to retire in 2008 and 2009 and couldn't because they lost 50% of their assets? Or do you take the conservative position and just run out the clock, take the money that you have and get a steady Eddie return on it that you can know that you have a promise or at least or some guarantees as opposed to hope? So, and that's the paradigm. We have as you go into retirement, you need to shift your way of thinking, shift your perspective. And with interest rates today being what they are, it's easier than ever to shift your perspective, to shift your paradigm.
Yeah, it is. And we're talking about that, we talk about risk adjusted returns. What risk profile are you willing to take? How much drawdown are you willing to take in order to get the returns you need? The other part, when you and I talk about risk adjusted returns, we talk about a hope-based versus a promised or contract-oriented return. One is the model of, I hope that this asset goes from $10 a share to 11 to 12 to 13. And the other is, I know that this investment is going to pay me this much. Now, it could always do better, but I know that I'm going to get the minimal of this amount, other than something like, default or something like that.
Right.
If people were to guess, and if you have a piece of paper, you should write this down to make sure you don't cheat. If people have wanted to guess from 2000, the year 2000 to, the end of, let's call it 2022, what they would have earned if they bought an S&P fund and just left it alone, what that annualized rate of return would be. Now, keep in mind that there was two about 50% corrections in there, a 40, 25 or 30. It was a roller coaster. But if you annualized it out, what your return would be for stomaching all that volatility. AAA, do you know the answer? I think people got it written down.
A whopping 6.5% per year.
Wow.
How about that? Wow.
That's heart-wrenching.
Especially with the new paradigm.
And when you hear CNN or CNBC, or you hear these financial organizations talking about pushing how great indexing is and how great these things are and how you're going to earn 10% and all these kinds of things. If we back up further and we look at 150 years, I think, what would be the S&P did about 9%. And
Daniel, let me just stop you there for a minute, because you say, when they say you do 10%, well, it all depends on what time frame you're talking about. Because, we talked about on this show before about how, the stock market, doing an average over a period of time has averaged 7%, but yet investors over that same period of time, the retail investor did 2%. So, they're not getting 10, they're not getting even 7, they're getting 2 because of how they invest. So, it's smoke and mirrors. And that's what, people don't know what people don't know. So when people talk in these terms, you're going to get 10%. Well, the question needs to be over what time period? What's the parameters with that? What's the other things that go with that to quantify that 10%? And people don't get it. And so people are looking for, pie in the sky. They're looking starry-eyed, looking for these enormous returns in a retirement that just are not going to happen like that anytime soon.
And that's the second paradigm, right?
Right.
Going from a younger growth kind of, I need to build my assets, to retiree where I've built my assets and I need my assets to pay me. Because if we use that 150-year example at 9%, you're not going to live 150 years.
Right.
Especially if you are already, in retirement or close to retirement, you're not going to live another 150 years. And that's where that paradigm shifts, where you go from a growth over long periods of time to I need these assets to pay me so I can be confident in the lifestyle I have. We talk to too many people who come in and see us who have other advisors who have either they're managing their money or growth-oriented people managing their money. And they're worried that they are not going to have enough money, not because they haven't accumulated enough money, but because they know they're spending down their assets and they've stomached these big drawdowns already through their lifetime. And they don't want to have to experience that in retirement.
Right. Retirees' greatest fear is running out of money before they run out of life. And that is the key that we want to bring to each and every retiree. That's why we're talking about how to retire and stay retired. Now, one of the things when you go to retire, you need to know, well, how much do I need to retire on? Well, that's a great question. And it's one that needs to be known before you can do anything about retirement. Before you can know when you can retire or anything like that, you need to know how much do you need to retire on. So we have a 2-page paper that we'd like to put in your hand to be able to help educate you on that so that you can know what you don't know and that you can be an educated retiree, thus a stress-free retiree. And call us 800-725-7616. No obligation, free paper, 800-725-7616 for your paper. How much do I need to retire and how to figure that out? Now, today's topic of you're listening to Financial Strategies, Andrew and Daniel Agemy. Today's topic is Dream Retirement, a new paradigm. And Daniel, Dream Retirement. We've been talking a lot about new paradigms, right? How retirement is a paradigm shift, and people can switch their paradigm on their investments from a stock market aggressive approach. You didn't say, we talked about the 6.5% stock market approach over 22 years, but this, to a 6.25 with a lot less risk. I mean, that quarter of a percent difference is, in my mind, is not worth the risk difference. What do you say?
Well, those numbers you're talking about. So the 6.5 is what the S&P has averaged in about 22 years. Right. And people might say, well, I did better than that. And if you did better than that, it's because you were doing what's called dollar cost averaging. And so when those crashes happened that we talked about through that period of time, you were buying low. So you increased your return. That return we're talking about is if you just bought the S&P and sold it. Now, if you did the opposite, if you bought it and you were selling out to support your lifestyle through that same period of time, you wouldn't have done anywhere near the 6.5. You would have done much less. Actually, you probably, depending how much you were taking, you would have run out of money in that period of time. And that's what people intuitively know. They're not able to explain this. They come and talk to us. They're not able to explain this, but they intuitively know that because they've seen it, right? And now we're not talking to you day traders. We're not talking to people that love the market and that have a positive outlook, that think that things are really good right now and things are going to keep continuing to go up. We are talking to positive-minded people. We are talking to positive people. We are talking to people who have good outlooks, but we're talking to people who are a little bit risk-averse, who intuitively understand that they don't want to run them out of money. They don't want to go through these downfalls again. They don't want to have to day trade or pick individual stocks or watch, the financial news organizations to know what stock to buy today and then when to sell it and all this time. We're talking to the people who want to enjoy their retirement and not worry about the portfolio. Right. And that's where you came up with that other sign you were holding up that says 6.2 or 6.25. Because what we're talking about there is we're talking about collecting a spread on the 10-year treasury. So typically when you go into corporate credit, you want at least a 2% spread above the U.S. Treasury. So that's without any growth that you could get on top of that. That's without any trading in and out. That's without doing anything special. Okay. We're just talking about collecting that yield, sitting back, and they call it collecting coupons, right? Because you used to get a coupon in the mail, you'd clip it off, right?
Yep. Right.
Or you didn't get it in the mail, you had it, you'd clip it off and you'd send it in, and the company would send you the dividends.
Right.
So that's sitting back and collecting coupons. You could do better, but we're not talking about hope. We're just talking about what you collect. Now, which sounds better? Sitting back and collecting that 2% above the treasury, so 6.25, or you hope that you will continue to do the 6.5 with the volatility that we've talked about. This is risk-adjusted returns. This is exactly what we're talking about.
Yeah.
I don't know about you, AAA, but I would rather sit back, be able to enjoy my retirement and watch the money come in at the 6.25 than the volatility roller coaster for the 6.5.
Come on, you know about me. You know about me. You know what I want.
You like to spend, right? You like to spend, so of course you want that money coming in.
You know all about me. Yeah. Anyway, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Dream Retirement, a New Paradigm. We'd love to put this book in your hand to be able to help you understand more about that dream retirement and that new paradigm that's facing you today. The most important thing by Howard Marks, Easy Read book, where Howard goes in and he talks. This guy has had decades of experience in investing and understands how to make your money last for the rest of your life. And so we'd love to be able to put this in your hands, and you can have it for the first 5 callers at 800-725-7616. We have operators standing by, 800-725-7616 for your free, no obligation book. Call now.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, another example of this paradigm shift. I was talking to somebody the other day who owns quite a bit of real estate, and we did a quick synopsis of the income that she was making off of her real estate. So we added up property taxes, we added up insurance, no mortgage or anything. So don't have to worry about that. It's kind of apples to apples. Added up the expenses, and not even random expenses like you got to replace the refrigerator or the roof or things like that, right? Just the normal stuff. And then what she's collecting on rent. And do you know she could earn more money monthly by selling that place and putting it in a Fidelity money market fund than she's collecting after she pays her property taxes and insurance. And it's rented out. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Dream Retirement, a New Paradigm. And we're glad to be able to come to you today. And, hopefully everybody wants a dream retirement. I mean, you're working toward it all your life, climbing up that mountain of retirement. You just don't want to sit on the bench, on the porch in your rocker chair or sit in front of the TV. Hopefully you want a dream retirement. And we're talking today about how that you can get it with less risk. Daniel, that's a great example, because, what you said there about that was, she could put her money in a Fidelity money market account, get more and make more than what she's getting from rents after expenses. Well, that's what we're talking about with this risk, this risk reward thing, this risk adjusted investments, because her risk is higher with that rental property, because now she has work that she has to do to manage it. And you just slipped it in there. I caught that. You slipped it into the air at the end where you said, and it's rented. Meaning that if the other risk that comes into play is if you can't rent it, or you can't rent it for a few months. The people are in there, they're mad at you, and they move out, they rip out everything, and you got to take 3, 5, 6 months in order to replace everything besides the expense of that. That risk is not worth the reward. We're seeing this over and over again, folks, where we have real estate investors coming to us and saying, hey, the market's high, I can still get a good penny for my property. What would happen if, I sold that property and we invested this money? What could you do for us? And they like what they're hearing. They like the numbers that they can get without the work, without the risk. And that's what we're talking about with this new paradigm. The way things are now, the landscape has totally changed, and there's a new paradigm, new way of looking at things, which actually is kind of going back to the way people did in the 50s, 60s, and 70s, which really is not new, but it's just new for baby boomers, because baby boomers and next gens are not aware of this methodology and thought process, because they weren't about it. I mean, think about it. You probably, maybe your parents, your grandparents, maybe your great grandparents invested for dividends. That's the kind of thing. Dividends and interest. That's the kind of thing we're talking about here.
Yeah, getting excited about watching those dividends come into your account, right?
Yeah, remember the one one of our listeners, regular listener here, and hope this person is listening, but was telling us about their spouse waking them up at midnight so that they could hear the dividend reports and what they're going to be getting on dividends, and because they were so excited about that. Pretty cool.
Yeah. So this is where time frames matter so much, because I know a lot of people out there are listening and being like, you're saying the real estate, you could get the same amount in a money market fund, but you could get price appreciation. And it depends on your time horizon, because real estate can continue to go up. Absolutely, it can continue to go up. But in the next 10 years, do we think it's going to be substantially higher? And there's risks involved, like, a lot of municipalities, a lot of states are struggling with budgets, right? They're running out of the money that they got from the US government from COVID. And now they're starting to have to deal with budgets again. Capital gains have not been as good the last couple of years as they were previously, right? So states' budgets are having a little bit more difficult time. Now, definitely. States don't have money printers. Okay. The federal government does, but states don't. So how can states get more money? Well, they could raise taxes, right? They could raise taxes. They could raise property taxes. And anyone who owns real estate knows that they are raising taxes on the real estate. So these are other things that for the short term could damper price appreciation in real estate. So it's time frames. If you keep talking about keeping it forever, it's a good location, generational wealth, that's different. But if you're talking about your retirement and you want to maximize the income you can collect, you want to maximize the dependability of the income you're collecting, that's who we're talking about. And that's what we're talking about, because you don't know in 10 years if that real estate will go up or down. So if you can get the same amount in a money market fund, then what do you think you could do if it was actually invested to earn you interest, not just in a money market account, right? We talked about the spread above treasuries should be 2% or more, but we like to get, 3-4% above that.
Sweet.
Not just the 2%. That's kind of like you need to get 2% above that because you're taking on more risk. It's risk return. Again, you got to get more than 2% spread. Otherwise, it's not a good risk return.
Exactly. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Dream Retirement, a new paradigm. And we're giving away more educational information for you. Today, we have another paper for you called Passive Income for Retirement. Passive Income for Retirement, a paper that can educate you on what we're talking about to a further extent, give you some other perspective, something you can put in your hand and read and look at. You can have it for free by calling 800-725-7616, 800-725-7616 for your free copy. This will help you and prepare for retirement so that you can have that dream retirement, a new paradigm. You listen to Financial Strategies with Andrew Daniel Agemy. Daniel, risk and return, right? That's what this paradigm is about. That's what we're talking about. The risk versus reward scenario is different. And how many times have we heard people talk about, well, I don't have so much money or whatever. I need to increase my risk so I can make more, which is ridiculous. People in our listening audience, please think about this. Listen to this. I'm going to risk more so I can make more. If that were true, that you could risk, when you risk more, you make more, it wouldn't be risky. It wouldn't be aggressive. It would be safe. The problem is that's not a true statement. You might make more over a certain period of time. Like Daniel said, over 150 years in the stock market, you could make 9%, right? That's risk. That's better than the 6.25% we're talking about, but that's 150 years. Is that what you want to invest your money for, 150 years? Or would you rather take these other things? And when we're talking about that too, what we're talking about investing in is those things, those bond-like instruments that pay interest or dividends. And, there's some things that go up when the stock market goes up, but they don't come down when the stock market comes down. Sure, you don't make as much money as the stock market, but you don't lose anything ever. And that's one of the things that works. There's corporate bonds like Daniel's been talking about. There's even U.S. Treasury bonds. There's various things. There's bonds and bond-like instruments that will be able to help you to be able to have that passive income, that dream retirement, and you don't have to do the work like you do to have passive income from real estate investing.
Yeah, it's really a neat thing, and there's a confidence behind that. So when you're talking about bond and bond-like instruments, these are what we like to call investments that have a contract backing them up. And you told a story the other day about how that relates to like a mortgage or a bank. Do you mind sharing that?
Sure. Well,
to explain to the listeners what we're talking about when we're talking about contract related, right? We talk all the time about how, especially equity investing is just hope. Indexed investing is just hope. You hope that because the past it's gone up, it will continue to do that. And the difficulty is people don't usually study the past to see that it doesn't happen every year. You don't earn 9% every year. There's 10 years where it does nothing. You stay still. I mean, it goes up and down a little bit, but after 10 years, it's the same place it was. And there's times where it goes up tremendously. There's times when it comes down. But that's not what we're talking about. We're talking about something that has a contract behind it. And would you explain that to the listening audience?
Yeah. So, most people in our audience either have or have had a mortgage on your house, right? And with that mortgage, let's say, you borrowed $200,000 from the bank, and the bank has a contract. They give you the $200,000 and they know how much interest they're going to make. They know how many dollars they're going to get from that. And they know when they're going to get their money back in a worst case scenario if you don't pay it off early. And probably a lot of you pay off your house early, which is fine. But what I'm doing is illustrating a contract versus hope. Okay. So this contract that you have at the bank has loaned you money, and you have signed this contract that if you renege on your contract, well, they're going to take your house, they're going to take your down payment money and all the money that you put into that, and you're going to get nothing. You're going to get ruined credit. So you're at risk. You don't want to renege on that. You want to pay them according to the plan, because if you renege, it's like the kiss of death to your household finances if you were to do that. So, but the bank has this contract with you and they are secure. Worst case, they're going to get the property. Worst case. And then they can sell the property and get money back from that standpoint. And that's what we're talking about when we're talking about contracts, investing by contract. But you're the bank. You're loaning these companies the money, and the companies have signed a contract with you saying they're going to pay you X percent over X period of time, and in a worst case scenario, you're going to get your money back at this point. And if for some reason the company goes out of business, you have assets to the company that you're going to get.
You get the company. Back. You get the company. Yeah, the bondholders get the company. Yeah.
Right. So point is that, you're loaning, you buy a municipal bond, you're loaning money to the town that you're, giving that money to. You buy a U.S. government bond, you're loaning money to the government, and they're giving you in return a contract that you know what you're going to get. There's no hope. You might get more than that, but generally speaking, you're not going to get less than that, generally speaking. Whereas invest in a company, right? You buy a stock to a company. I mean, you're third in line. if the company goes bankrupt, well, actually you're fourth in line because the company goes bankrupt, the IRS is there, then bondholders are there, then preferred stockholders, and then corporate, then the common stockholders, are there. So you're probably not going to get a single dime for your money. And depending if you bought it on margin, you may actually lose money on the deal. That is not what retirees need to. That's how retirees are not going to have a dream retirement with that old paradigm. They need a new paradigm. Yeah, the dream retirement. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is dream retirement, a new paradigm, and be able to help you have that new paradigm so that you can understand it better and more thoroughly so you can be an educated retiree. We got a book for you, The Most Important Thing, because people don't know what people don't know. And if you don't even know what questions to ask, how are you going to even know anything? So get this book for the next 5 callers at 800-725-7616 for your free copy, no obligation, 800-725-72616. Let's try it again, 800-725-7616. Okay. And for your free copy, I'm glad to give it to you, and call now.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
The year is 1980. I was 22 years old and I had $10,000, which in today's dollars, that's probably closer to $50,000 today. And, in 1980, people, 22-year-olds were, didn't have the kind of money that 22-year-olds have today, it seems like to me. But nevertheless, I didn't know what to do with my money. I had $10,000 and I didn't want to spend it. I wanted to save it, and I didn't know what was the best way to do with it. So what did I do? I turned to my older brother and said, what do I do with this money? And he turned me on to, I could put the money in mutual funds or I could put it in a money market account. Now, this money market account was paying 18%. The mutual funds were paying over a 10-year average 15%. So I was smart enough. This was before I was in finance and everything. And this is probably one of my first lessons in finance was I put 2 and 2 together, and I was smart enough to understand that the no risk 18% in the money market was like a no-brainer. Why would I risk it to make more? To make less. Why would I risk it to make less? Because it was paying 15% on average. So I put it in an 18% money market account, and that was pretty sweet, right? Because my $10,000, I was getting almost $2,000 a year of interest on it, which was phenomenal. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about dream retirement, a new paradigm. And AAA, that's pretty cool story. There's probably quite a few advisors, people on these financial networks that should talk to the, older version or the younger version of yourself, because that's pretty simple, but people have a hard time getting that. And that's why we're doing this show, right? Because it's a paradigm shift that has not been for so long. But the example we give with the lady who has the house, and she can get more by just putting the money in a money market fund than all the work involved in renting that thing out.
But it's hard. It's hard to change. It's hard to teach an old dog new tricks, right? Not that you can teach an old dog new tricks, but it's hard. And that's what we're talking about. That's what we're talking about with the new paradigm. Today's show, Dream Retirement, new paradigm, right? New paradigm is new tricks for your retirement, new tricks that you have to learn. You have to look at things differently. And some things are very simple. But there's sometimes they're so simple that they don't look right. It's kind of like salvation. Salvation is a very simple thing that there's nothing we can do to earn going to heaven. It's not being good enough that gets us to heaven. It's what Jesus did for us on the cross that makes the difference. And it's not what we do. All we have to do is accept what he did for us. And that's so simple. People have a hard time receiving that. And in the same way, that's kind of like what we're talking about here. We're talking about this stuff that's so simple. Those people that have ears to hear what we're saying will get the idea and be able to be blessed by it. Those people that don't have eyes to see and ears to hear, well, hopefully it's a good story. We're having a good time together. And so they're enjoying our entertainment value, right? But,
right.
That's the thing. is that we need to be able to understand how to put this into action. So the point is that too many people in and close to retirement are putting their money at higher risk than what they should. And then what they need to.
Yeah.
Exactly. Secondarily, they don't have the money that they need to go into retirement. I can't tell you how many times I talk to people. I do a retirement risk report on people that, and they do not have the money. They have a lot of money, but if they're going to spend it, okay, they can live, 10 or 15 or maybe 20 years if they're just going to spend the money. But who wants to spend their principal? You want to live off the interest and dividends. That's what our parents did. That's what our grandparents did. That's what happened in the 70s and 80s, where they lived off the interest, not the principal. They had high interest rates, much higher than we have today, but nevertheless, it was a similar thing from that standpoint. So we have to be able to learn how to choose your risk, the investments that you use based upon your risk and what's your risk tolerance, not some guy working for a Wall Street firm or gal working for a Wall Street firm and what they say your risk is. What truly is your risk?
Yeah, that's huge. That is absolutely huge, because we talk to people all the time who say things like that, like, I don't want to lose money. I don't want to have to go through what I went through in the past. I lost a lot of money in, 2008, 2009, right? I don't want to do that. And the paradigm shift here is again, twofold. Number one, it's if you're near or close to retirement and you have already accumulated your wealth, the paradigm shift is saying it's not time to, number one, try to accumulate more wealth. Number one is to protect the wealth and collect an income off of my wealth, to collect a stream of money. That means your $1 million, whatever it is, sits there and it pays you $65,000 a year. It pays you $70,000 a year, and the million stays intact. Now, it could move up a little, it could move down a little bit, right? But you're going to be collecting that interest and dividends. Paradigm two is...
Daniel, let me stop you there for a minute. When you're talking about that, because you're saying you get the income, right? But I just want to let people know, if you don't need the income, we can reinvest it and give you more income. Okay, so you grow your money the old-fashioned way. It's not that you need to receive this income. A lot of people, I know there are people in the audience, Daniel, saying, but I don't need an income, right? Then that's okay, because you can reinvest it and you get more when you do need it. Go ahead, Dan.
And that brings us into paradigm shift two, because typically by taking on equity risk, you get a better return. And what we're looking at right now with the uncertainty, with all the craziness going on in the world, with these states, with these governments, with the divide in the country, all this stuff, and equity prices being maybe high, maybe low, but the returns are not great, are not far substantial to the risk-free rate, then it's going to be difficult to earn risk-adjusted returns that are positive. And then when we look at what you can earn in these contracts, in these bond-like instrument types of things, where they will perform better than indexing on a risk-adjusted return, but there's a huge possibility they are going to outperform indexing on an absolute return. We don't know for sure because we can't predict the future. But why would you take on that additional risk for no additional return?
Right. That's crazy.
And that's why I think it's so important that you said you don't need to take on this risk.
Right.
You don't need to, because you're not taking it on to get an extra return. I could see it, when interest rates were zero, why you would want to take on equity risk.
Right.
There was still good things then that you could still collect a nice income, but now it would make no sense for someone who is in or close to retirement to be taking on that risk. If they need, if they want to protect what they have, they want to leave generational wealth, and they want to be confident that the retirement can sustain the lifestyle that they want to have.
You've got a good point, Daniel, when you said people want to protect what they have. Many retirees, I got to say, probably 99% of retirees I talk to say that they're more conservative today financially than they were when they were 20 or 30 years old. It's a fact. They may still like to be aggressive with some stuff, and it might still be kind of fun to remind them of the old days, but mostly they're conservative. So the question with that is, what do you do with it? Well, you invest it in contracts, bond-like instruments, things different than what Wall Street tells you. Wall Street makes money if the market goes up, the market goes down, the market goes sideways. But when do you make money when you're invested in Wall Street, in the market? Only when it goes up. The things we're talking about, you're making money all the time. Your money's working hard. It's in the sweatshop. It's not sitting on the beach sipping pina coladas like most people's money in the stock market right now. Because right now, your money is in the stock market. If you haven't added anything to it, you have less money than you did in January of 22. So to me, that's not very good. Whereas if you're investing it in bond-like instruments, things making dividends and interest, well, you're ahead of the game. And we have clients that are increasing their retirement income by 10, sometimes even 20% per year because of the money's in a sweatshop working hard. But part of being in a sweatshop working hard, it's diversification. Right, Daniel? Diversification, true diversification and sitting money up in a way that it's in a lot of different things, like the verse out of the Bible says, Ecclesiastes 11:1-2 says, cast your bread upon the water, give it unto 7 portions, even 8, for you don't know what disaster will come upon the land. And that's the idea, that you can't just put it all in the stock market and different types of the stock market. That's not diversification. You want to be able to put it in different kinds of things. So much in maybe commodities, gold and silver, so much in stock, maybe so much in bonds, so much in cash, so much in these various types of things. True diversification. If you want to know what true diversification is, we have a show on that. Any place that you listen to podcasts, you can listen to our show, previous renditions of it, and also future. So, make sure you do that, or check us out at agemy.com, agemy.com, as they're all on there as well. But diversification is a huge aspect, and people don't diversify properly. That is one of the pitfalls they make. People don't choose the right investments. They let somebody else choose the investments. They don't have a say in it, and they blindly trust people that all it takes is one advisor to ruin your portfolio.
Yeah. So I think what people need to take out of this is if you're near or in retirement, there's a paradigm shift going on for you, right? The paradigm shift is going from I am going to work and I'm collecting an income to now it's time for my assets to pay me that income. Now it's time to collect my paycheck from my assets, but not by selling them down. And paradigm 2 is this beautiful, beautiful opportunity, this delightful opportunity that people have where you can earn risk-adjusted better returns, potentially the same returns, by lowering your risk than what you can take by taking on traditional equity type risk. And this paradigm has been given to us because, Jay Powell's over there raising rates. And the opportunities for people who want to protect the principles and collect the income is just a beautiful thing that I hope people have, as you said, eyes to see and ears to hear this opportunity that has been presented, because I don't know that this will last forever. At some point, the U.S. debt is going to get so crazy and rates won't be able to be so high. But right now, people can lock into these rates. And that's not just buying a 1-year CD. That's not buying the money market account. This is participating in investments that will be around for a long time, that can pay you interest for a long time.
Right.
So that you can continue to collect that even if rates come down.
Right. You got to take a look. So you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been Dream Retirement, a New Paradigm. And one thing that we believe in here is that an educated retiree is a happy and stress-free retiree. We like to give you a book so that you can educate yourself more on the things that we're talking about. Howard Marks talks about the most important thing and how you can be prepared for retirement. Make sure that you don't outlive your money. Make sure that your money lasts longer than you do. Love to put this in your hand to the next 5 callers at 800-725-7616, 800-725-7616. We looking forward to you tuning in again next week, same bat time, sit back channel, or listen to one of our other podcasts at Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And an educated retiree is a happy and stress-free retiree. 800-725-7616 for your copy. The most important thing, call now.